Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will speak about the Warren Buffett's wisdom for factor investors.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Quantpedia. The topic of today's video will be Warren Buffett. Warren Buffett is surely one of the best investors of our time. He has a net worth of over 100 billion as of August of 2022, which makes him the world's seventh wealthiest person. There is no surprise that there are a lot of academic papers that are related to him. They are showing what is his trading style, what is his investment style, etc. etc. So I selected two papers that I think are the most interesting. We will go through it. We will try to understand more what Warren does and why he's the best in what he's doing. The first notable paper that I selected is called Buffett's Alpha and is written by Frazzini, Kabiller, and Pedersen from AQR Capital Management. So what did those guys do? They took the information about Berkshire Hathaway portfolio. We can see that the Berkshire Hathaway portfolio, the Warren Buffett's portfolio, has a Sharpe ratio of 0.79 and that it has significant alpha to traditional risk factors. But then they try to check what is the alpha when they control for exposures to two specific factors. One factor is called betting against the beta, and the second factor is called quality minus junk. The first factor is factor that is connected to low volatility and low risk stocks, and the second asset is connected to high quality stocks. They also estimate that the Buffett's leverage is about 1.7 to 1 on average. When they control Warren Buffett's portfolio against the betting against beta and quality minus junk factors, and then apply the leverage 1.7 to 1 on the resultant portfolio, so they match the same leverage as the Warren Buffett is using, they see, or they were able to completely match Warren Buffett's performance. It seems that Warren Buffett's alpha is not especially the alpha. Warren Buffett is very, very skilled in trying to get return out of the factors or out of the systematic factors that are well known, but he started to do it much sooner than anybody else, because he started to invest in 1950s or 1960s. Let's open the paper to see how does the chart look like. So when we take a look on the paper, we can take a look what is the performance of Berkshire Hathaway public stock or public stocks. So that the performance of the stocks that we know from the 13F fillings is the blue line. We have a performance of the overall stock market, it's a green line, so we see that Warren Buffett's portfolio clearly outperforms the public market. And then we have a Buffett style portfolio for public stocks. So it's a portfolio that tries to mimic the factor performance or factor loading of Warren Buffett stocks. So it's a portfolio that holds high quality stocks with a low beta to overall market. What we can see is that correlation between the red one and blue one curve is nearly the same, and also the red one curve outperforms the blue one curve. The question is, what are those betting against the beta and quality minus junk factors? So let's take a look on those two factors. What is the betting against beta factor in stocks? In the real world, some investors are prohibited from using leverage, so they cannot borrow money and invest into the stocks. So instead, they are trying to overweight the risky stocks instead of using the leverage. And this overweighting of risky stocks, or this very high interest in the risky stocks, makes these stocks very expensive. This behavior suggests that high beta stocks should deliver lower risk-adjusted returns than low beta stocks. What are the high beta stocks? High beta stocks are the stocks that have the higher performance when the market is going up, and also higher drawdown when the market is going down. So they are highly risky stocks like the tech stocks or leverage stocks. And what are the low beta stocks? Low beta stocks are defensive stocks that have the lower performance when the market is going up, but also the lower drawdown when the market is going down. Investors that are not limited in leverage, they can exploit this inefficiency by betting against beta. So it means we can go long on a portfolio of low beta stocks, leverage. So we can use leverage to beta of 1, and we can short the portfolio of a high beta stock, so high risk stocks, which is deleveraged to a beta of 1. And that's exactly what Warren Buffett is doing. So he is buying the low beta stocks, but he has access to very cheap leverage from his insurance company. This betting against beta factor works very well over the long term, so the performance is really interesting. Now, the second factor Warren Buffett is using is called quality minus junk, or what is the quality factor in stocks. And what is quality factor in stocks? The quality investment style buys fundamentally strong stocks and shorts fundamentally weak stocks. The criteria often involve profitability, safety, growth, payout metrics. So high quality stocks tend to be stable, profitable, and with the growth. And these characteristics are connected with outperformance across many studies. And again, especially during market downturns when there is a flight to quality. So what does it mean is that Warren Buffett again buys stocks that are highly profitable with the growth of the profitability, and is not owning the stocks that are weak, and is again using the leverage to buy these stocks. As we can see, the quality factor has also positive performance during the last lot of the years. So when we combine both of the factors and we apply the leverage, we have the nice outperformance, the same outperformance as the Buffett had in the past and as the Buffett still has at the moment. So the only difference is between us and Buffett is that Buffett started to invest according to these rules, 50 or 60 years ago. Those two styles and the paper about Buffett Alpha is not the only interesting paper that's showing the Buffett's wisdom. There is another paper that's called the Buffett Indicator. So the question is, what is the Buffett Indicator? The Buffett Indicator is a ratio between market value of the equity to gross domestic product. It's a very simple stock market valuation ratio. It's useful mainly to compare individual countries among each other. So we can see which countries are relatively undervalued and which countries are relatively overvalued. We can see, so in case we have a very high market value of equities compared to gross domestic product, to GDP, we know that the equity market of the current country is too expensive. And if you have the market value of the equity market low compared to GDP, the equity market is probably underpriced. It's a ratio that's similar to cyclically adjusted price to earnings ratio, or CAPE ratio. And as I said, we can use it to select the countries that are relatively undervalued, and we can give higher weight in our portfolio to those countries. So if we use this Buffett indicator to build a strategy, we can, instead of using market cap weighting of all of the countries around the world, we can try to give the higher weights to the countries that have the less expensive equity markets or undervalued equity markets, and we can give the lower value to the countries that have the very expensive equity market based on the Buffett indicator. If we change the weighting this way, strategy can have an excess return that is really significant compared to equally weighted country index or compared to market cap weighted country index. Thank you very much for your attention, and I hope you will join me in the next video.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.